Just give me a quick 30 seconds to set up my timer. Hi, I'm audible. Hello?
Yes.
All right. Starting my speech in 3, 2, 1. In a world where economic uncertainty is become the norm, floating exchange rate have become a weapon of political power and also big nations, fueling crisis and also to destabilize the entire market, leaving entire nations at the mercy of the speculators. So this looks like the transitions from from the fixed and to floating exchange rate was not just an economical shift, but it's a gamble on the sacrifice stability of volatility. Today, in open government, we push to you that developed economies cannot afford to let their currencies float freely in a sea of unpredictability. It is time to regret these transitions and recognize that only fixed exchange rate can restore the order and of the country. What's the framing coming from side opening government? Two things. One, we want to tell you that what's the role of developing countries in the international markets. One, this looks like developed countries are usually become the trade hub internationally, which makes countries and also investors want to channel investment. They want to enter into the country to invest, and they want the developed countries itself want to channel investment into the country. The problem with this is investment will prefer the stable currency in order for the country to have a stable FDI, which is foreign direct investment, which means that investors are more likely to invest in a country with fixed exchange currency because there is a stable currency exchange rate in the country itself. But B, developing countries use these developed countries' currency as well. The intuition pump here is simple. It looks like United States' biggest export is their US dollar. It looks like China are actively de-dollarized because they want to weaken the power of US. Also look like the oil agreement. Oil can only be traded in the United States dollar. This affects the developing countries, and the countries it's underdeveloped countries in the global scales. But the second thing in the framing itself, right? How this basically affect the developing countries and why are they volatile? The first thing is the price of products are uncertain when they purchase essential item like your oil by using foreign country. This looks like when you're purchasing something with a volatile currency, today it might be 500 USD, but tomorrow it might be 600 USD. It's because the inflation and also the uncertainty on the currency of Chinese yen. But the second thing is we're able to tell you that country that hold foreign currencies might get devalued in terms of their country assets. This looks like this will basically make them become even poorer because the assets they have might get devalued just because they might get devalued simply because of the inflations in terms of currency rate. What's the counter proposals coming from side OG? One, we tell you that we propose fixed exchange rate in the current status quo. Why? How we want to propose this counter proposal, which is how fixed exchange rate going to looks like and how this benefit the country and also in the global scale. The first thing is the country rate is fixed in terms of currency rate. The second thing is the country, how we're going to do is developed countries pin their currency with other developed countries together as a fixed exchange. This looks like your United States dollar to Chinese yen. It's always 1 to 5 exchange rate, etc., etc. Why this is good then will be further explained in my argument. First argument, floating exchange rate cause uncontrollable currency volatility. Why this is true? This is true simply because that the floating rates fluctuate constantly due to the speculations and also like your geopolitical shocks. Looks like, for example, when during Brexit, right, it caused a very significant Great Britain pound drop in terms of currency then. But the second thing that you do note that is many developed countries experience an extreme exchange rate swing after moving to floating system. For example, the Japan yen because volatility disrupted the entire exports economy. 10 years before, when I went to Japan, 1,000 Japanese yen is 40 ringgit Malaysia. But today, it's only 30 ringgit Malaysia. How volatile it is, it's obvious. But the third thing is central bank will struggle to control the inflation and also the exchange rate under floating system. This has been seen in the challenge when we are stabilizing the United States dollar. Why this is good? This is good because there's a predictability in exchange rate help the business plan. The business are able to know that how much money that they need to have in order to purchase certain products. The fixed rates makes exports, imports, and foreign investment safer, not only for the country itself, but also for the foreign investment that are entering into the country. This is a safety net for them. But the second thing is, this prevents sudden inflationary pressures that harm the consumers and business. The third thing is, this ensures a stable interest rate and borrowing cost so that you don't have to pay a significant amount of interest when inflation happens. This happens during the COVID-19. What's it called? Yeah, basically COVID-19. This is important because of three reasons. We proved only three impact. One, a volatile currency can crash the economy, but we don't want to do so. This can be seen in Argentina and Turkey currency collapse. It shows how bad the floating rates are. The second thing is developed countries rely on a stable global trade, and a floating exchange rate disrupt the supply chain and pricing. And it also cause uncertainty discourage a long-term investment in your country, which will lead to a slower economic growth in your country itself. How fixed exchange rate going to come into the world to solve this issue? Fixed exchange rate prevent currency from collapse and speculative attacks. And this ensure the business and your government operate in a stable financial environment. You won't getting 1998 financial crisis again, and also the 2007 financial crisis, 2008 financial crisis again and again, because we're able to stabilize. There is no speculative attack towards your own currency. Second argument then, why floating rates increase the financial crisis then? This is true because of two reasons. One, floating system allows people to manipulate your currencies, there's foreign interventions to your inflation and other devaluations. The example here is simple. When 2008 financial crisis showed that the exchange rate of volatility worsens, the economic downturns as your capital become unstable currencies. This looks like the countries with a fixed exchange rate, like for example China and Hong Kong, better cater to the crisis because they control the capital flows during the crisis then. This is good because a fixed system stabilizes the inflations, and it becomes a shield when when crisis happens, when you have speculative attacks by big shark in the world. But the second thing is the central bank can focus on economic growth rather than constantly adjusting the exchange rate, which is pretty insufficient to deal with this issue. Impact they will prove to you here is we don't just developing countries are able to peg their currencies to developed countries. When developed countries fluctuate, it will make the market suffer. We don't want them to suffer, therefore, it's better for us to have a fixed economy. How we deal with this issue? A fixed exchange rate prevents currency speculations and also financial crisis by keeping exchange rate predictable, because this can maintain the economic stability and avoid the chaos seen in the floating rate crisis. With all these reasons proposed.
I'd like to thank the speaker for that fine speech and to welcome the leader of the opposition to begin the case for opening opposition. Hear, hear.
Hello, just give me a minute and then I'll start. I hope I'm clearly audible.
Yes.
All right. Can someone share the timer? Can someone share the timer?
Yeah, unfortunately, I'm not able to time. So, you might have to either time yourself, or if any of my panelists are fine to time, that's also okay.
I'll do this. Just a second.
Thank you.
Thank you.
Okay, Akshita Kumar, she/her preferred mode of taking a POI would be via the chat, preferably after the 5th minute of my speech, starting my speech on a self count of 3, 2, 1, go. The very first thing that this entire debate needs to realize is that you cannot benefit from predictability if the prediction is used to overestimate the currency of developed countries and underestimating currency of developing nations or other vulnerable countries who, in order to keep up, have to make sure that their governments have enough resources, have enough foreign reserves in the first place, because once they run out of the reserve of foreign currencies that they have, then the economy is unable to keep up. If the economy is unable to keep up, then the entire economy of that country falls, right? And then it struggles to then maintain the levels that it needs to get back up, which then also delays the entire process of economic practices that take within the country, also leading to greater implications than there would be on our side of the paradigm, right? Which means that at this point, a lot of the benefits that the OG comes and claims of less volatility, etc., are something that is worse on their side of the paradigm, simply because of the monopoly that this fixed exchange rate allows, right? Because then within the floating exchange system, this automatic adjustment is allowed with the simple forces of supply and demand, which then go ahead and navigate the entire scope with lesser government intervention. Whereas on the side of the fixed exchange system, you see like the government intervening and then going ahead after the fifth minute of my speech and going ahead and like setting these standards for the specific currencies, right? Which then the entire idea of political occupancy that the gov comes pushes is also something that gets mitigated to some sort of point, right? Which then also means that at a point in time, we carried the world as a heavily globalized world where economies are opening up and there is a higher level of economic interaction. Then there is also a need for flexibility to go ahead and create a level playing field for all countries, which is something that opposition at all points of time does not believe is something that happens in the fixed exchange rate system. Why? Because it creates a monopoly of the currencies of Western and developed countries, right? This monopoly of these currency gets created, which then puts their economy in benefit at all points of time, because it creates some sort of artificial overvaluation of their currencies, due to which all the other vulnerable economies are something that goes ahead and suffers from that specific monopoly, right? Which means at a point in time that there is monopoly of the fixed exchange rate system of developed countries, then there is lesser autonomy, lesser flexibility for all other economies to go ahead and work towards it, which means that we then go ahead and promote the entire point of floating exchange economies in developing countries, right? Why? Because then we can go ahead and protect the economy from inflation and other financial crises according to how the market forces work, with lesser intervention from what the government from the government intervention, right? Which then means that we are promoting greater economic autonomy, and always because under a fixed exchange rate system, the government has to always maintain large foreign currency reserves to stabilize their currencies, limiting their ability to allocate resources to other economic priorities, which the country must need, because at all points of time, they are totally convinced into going ahead and maintaining whatever threshold that they have in order to go ahead and maintain the foreign reserve that they have, right? Because then these fixed system forces central banks then also to prioritize the stability of these exchange rate and to defend the prices in order to go ahead and have a functioning economy, because they just cannot risk losing their reserves in that case, right? In a floating exchange rate system, however, this allows the currency values to adjust naturally based on like the forces of like supply and demand, right? Meaning that now central banks do not have to intervene constantly or like spend shitloads of money to go ahead and just defend a currency, right? Then it means that these people then can go ahead and like apply more adaptive and effective policies as a whole, right? Now, secondly, on the point of like companies and global competition as far as like businesses are concerned, then there is an accuracy in the way you go ahead and invest your plannings, as well as the level of your exports that go ahead and then take place, right? Why? Because for business people, they end up becoming more competitive, and then they do not rely on forced cheap currencies, right? Of these artificial overstimulation or understimulation of these currencies, right? Because then they can go ahead and analyze the market on the face of it, because then fixed exchange rates often distort currencies values, either it's overvalued or undervalued, right? That harm businesses particularly. Whereas whereas floating exchange rate system ensure that the currencies adjust according to the economic processes that have been taking uh, that have been going on in areas of the economic place, such as inflation, interest rates, etc., right? So this allows the businesses to go ahead and make more accurate trade and investment decisions. This also means that now companies can better plan exports, imports, investments based on like the actual market conditions rather than government imposed rates, because then it allows them to disengage from whatever the government has been imposing and like view the market forces in and of in itself in whatever like a glory that actually exists. So they're able to analyze things better because of the nature that they can go ahead and naturally adjust. Before that, POI.
Floating currencies give you the unique ability to be able to devalue your economy whenever you want to, because your currency isn't pegged to an objective good like the dollar. It's pegged to your own supply, your own ability to print as much of the currency you want. How does that not make your situation worse?
Because if you go ahead and then print more money, then it will obviously lead to inflation, right? Which means that at all points of time, you have to go ahead and balance the level of your currencies, which means that if the dollar then goes ahead and becomes overvalued, then you also have to go ahead and match that. Because at all points of time, you cannot let your currency get devalued a lot, right? So you have to maintain that balance within your reserves. And if your currency gets devalued, that just means that you have to maintain more foreign reserves, which at all points of time is not possible for each and every country, for each and every economy, because then again these market forces that the floating system allows is these people to go ahead and adapt to their own economic conditions, to the economic conditions of their market, without having to rely on whatever artificially regulated or overvalued currencies that these governments are then imposing on other countries, right? Which means that at all points of time these economies have better autonomy to go ahead and participate in the global market as a whole. With that,
I'd like to thank the speaker for that fine speech and to welcome the DPM to conclude the OG case. Hear, hear.
I just want to check if I'm audible and clear.
Yes.
All right, just give me a few seconds and I'll get started. Start my speech in 3, 2, 1. The problem I have with opening opposition is that their case is largely unnuanced to the idea that these particular impositions of a fixed rate are only going to be placed onto your developed countries. We explain in Yanjoo's speech the importance of certainty for a developed country for a few reasons. One, we've already explained to you that developed countries play large, significant roles in how the global market generally operates, which is why any form of inflation or economic impact onto a developed country such as the US, because of the pervasiveness of their influence within global markets everywhere through things like their currency and the US dollar, are things that have large tipping points and large impacts towards other countries. The reason our mechanism tells you for the US dollars and China and other developed countries to pin their currencies against each other is that it's something that's likely to create some level of certainty in regard to the investment that they're able to make. Why is this important? I'll explain later, and I'll also explain to you why these forms of securities that you're able to get exclusively from developed countries are things that can trickle down to developing countries when they want to then fix their rates against these countries because of the market security that we're able to give them. Here's a first response to like opening opposition, right? Where they say through their model, they're able to give a fair playing field for all countries. The problem here is that the problem with your alleged flexibility is that it's on the assumption that this shift in market is one that's favorable towards your developing countries and something that's in turn likely to be beneficial for them. If anything, the volatility during a crisis is something that impacts developing countries significantly more. I'm unclear as to why the flexibility of the market is going to manifest in such a way where it becomes favorable or a level playing field between developing countries and developed countries. I'll explain to you why developed countries fulfill that burden of being a fair playing field through our mechanism. First question then, on why floating is inherently problematic in the way it's being done in developed countries, right? No, I've already explained to you the importance of the role that developed countries play in today's economy and how this happens. Note, Yanjoo's also posited to you the fact that is as important as these countries are, they are still subject to risk of volatility. For example, things like inflation, things like pullouts or like from investors, or things like just general crises are all things that the big countries, like such as the developed countries, are still subject to. The comparative here is that I'm explaining to you that the trickle down of impacts towards your developed countries are so significant in the way that they impact other developing countries that the best mechanism or the best metric in which we provide global market security is through the metric of certainty. Here's because of the fact that other countries are impacted differently and there is a generalized reliance towards your global currency or like your general developed country. Second question then, on why the volatility of floating is something that we can absorb through things like fixed exchange rates and why that's inherently good in terms of investors and keeping and preserving the economies of these countries something particularly stable. One, understand that investment happens in all places, but the problem in your world is that investors are likely to then be particularly questionable about the extent of the investments that they make because of the fact that this market is so volatile that it predicts every single ounce of like minute changes. This means there is little to no guarantee that you're able to get, even if these investors are able to gauge the slight differences in market. But what this also means is because of the fact that these markets are so like transparent to the extent where it's so volatile and shown, things like perhaps countries that are perhaps going through a downturn are never going to get the investment support they need to bounce out of those crises. This is why there's been numerous intuitive pumps of instances where countries have opted into fixing their currency in order to re-encourage investments because they're able to guarantee a level of security to investors irrespective of outcome. Why is this valuable in the debate? This means that it's on our side exclusively that we provide you the best mechanism to secure continuity in the functionality or the stability of these developed countries. On the side of government or opposition, at best what you're able to get is maybe to better extent better market predictability, but this market predictability doesn't necessarily translate into a constant flow of money or security in the eyes of investors or in the eyes of partners that these companies or like countries actively engage with. For third question in my speech on why our mechanism also does a very unique thing in the fact that it's able to encourage certain form of like cooperations among big players in the global market and why it stops stupid things from happening, like perhaps politically like induced like economic like behavior that's likely to just be detrimental. The point in which countries fix, like big developed countries fix their market rates against each other, this is going to prove a few things. This means there is an interest that needs to be protected on the ends of countries. This looks like countries not purposely going out there and saying optically counterproductive stuff in order that's likely to damage their economy because there is a direct consequence to fixing their rate because there's also a loss that they need to incur or a liability that they need to balance out the point in which these things impact them. This means exclusively on our side that we are also able to largely mitigate things like perhaps excessive imposition of like tariffs, perhaps companies or like countries perhaps pushing political propaganda against other countries. This looks like people like Trump actively being mitigated on our side of the house exclusively because of the fact that we're able to create joint collaboration between developed countries across the board in this world. But sure, I'll take closing.
Do you think that the exchange rate is managed by the government or the central bank? Please engage.
Okay. I think, sure, the government has a role in this, but because the government has some level of engagement with its central bank, we don't think it's necessarily a full monopoly where these governments just like inherently lie about the capacity of the rates that they're able to fix that. We still think there's some level of reasonability that goes into how these rates are determined and etc. Because at the end of the day, the accountability mechanism still exists on these governments in the end, right? If they were to be discovered as a horrible investment and countries just end up not doing well, we think there's still a way to check and balance and regulate these countries. We don't think they're simply going to like overestimate and pin things to whatever degree they want. But even if that were to be the case, we tell you the certainty you're able to get for that is something that's still better. Last thing then in my speech, right? Why do we still make it better for like developing countries on the ground? The point in which we're able to give developed countries some level of security and mitigate volatility during times of crisis or during just general flows in the economic market. One, this means even your developing countries that are still going to rely on fixing their rates in both worlds have a proper reference point because note that this is a practice that's being carried out by developed countries too. This makes things like when these countries pin their value against these other countries who are more developed, there is a more secure investment here, which largely undercuts any of the COPOI to tell you why it's likely to be like volatile or like things like that, because we explained to you that we're able to give you that security, which makes investments for developed countries much better, meaning that we are able to bounce developing countries out of crises. 4 impacts we give you. We mitigate the volatility within developed countries, creating a better global market for all other
7:15.
countries that operate within it. But secondly, we
That's
also create...
global stop.
Oh, okay. Those are the impacts. For those reasons, OG.
I'd like to thank the speaker for that fine speech and to remind speakers to keep the length of their speech under 7 minutes and 15 seconds. With that being said, I'd like to welcome the DLO to conclude the opening opposition case and the top half of this debate. Here.
Audible and visible?
Yes.
Cool. Starting in 3, 2, 1. I'll take down the stupid term on volatility later, but first let's talk about how floating exchange rates allow for further economic flexibility and crisis adaptation. 1. You prevent foreign reserve depletion. Akshita has already substantiated, but I'll just impact it. Because under a fixed exchange system, governments have to go and hold vast amount of foreign currency to go and defend their own currency peg. What this does is that in terms of economic downturn, you burn through these reserves to maintain your artificial value of currency. But on our side, what happens is that floating rate eliminates this requirement, which is freeing up the capital for domestic investment rather than stockpiling these reserves. Second thing this does is that this avoids forced economic contraction. Because when a state lacks reserves to go and defend a peg, it has to go and resort to austerity. That looks like cutting spending, raising taxes, increasing interest rates, etc. What this does is this shrinks economic activity, that increases unemployment and that slows growth. What happens on our side instead with floating rates is that you allow market to adjust the currency value naturally, thus preventing forced economic stagnation at all points in time. Then third, we think that interest rate controls our domestic growth is something that is impacted better on our side of the case, because fixed exchange rates force states to go and align their interest rates with the currency they are pegged to. This means that they have to go and raise their rates when their economy needs stimulus, or lower rates when their inflation is already high. What this does on our side then is that floating rates give states control over the interest rates to manage inflation, unemployment, and GDP growth according to their own domestic needs at all particular points in time. So all of this gets you 3 deep impacts. 1, you are lesser dependent on foreign capital because countries with floating rates do not need to go and borrow in foreign currency to maintain their pegs and reduce their sovereign debt risk. Second, you have more efficient resource allocation because rather than holding reserves, funds can directly be directed towards infrastructure, healthcare, technology, etc., whatever you want to go and develop as an economy. Third, this gives you crisis resilience because countries can go and devalue their currency in downturns, that means making their exports more competitive and helping them recover faster. Because when your currencies are devalued and the currencies are cheaper now, it encourages import and export value in our own country at all particular points in time then. And at the point in time that happens, your economic crises are easily curbed down. But then, second thing that you get, we think that you're able to go and encourage innovation, trade, and sustainable growth on our side of the case. Why? 1, note, you break artificial overvalued currencies that hinder competitiveness because fixed rates often keep currencies stronger than they should be. This makes exports more expensive and local industries less competitive. What happens because of floating rates is that you allow currencies to go and depreciate when necessary, that is making exports more attractive and boosting your industrial output. Second thing then, we think that you encourage productive efficient sectors instead of rent seeking because 1, fixed rates allows industries to survive artificially due to protected exchange rates rather than competitiveness. What this does is that it creates inefficiency, stagnation in industries dependent on state intervention. What happens on our side is that floating rates force industries to go and innovate, automate, and improve efficiency rather than relying on state support at all particular points in time. What do you do then? Third thing, you allow countries to go and trade more freely without constant peg adjustments because fixed rates often require countries to adjust their pegs in response to trade imbalances that causes instability, which means floating rates allow natural adjustment on base of demand and supply, which looks like if an economy exports more, the currency appreciates, the trade balances naturally. So 3 impacts. 1, you have export-driven economies thrive, which means countries like Japan and Germany have leveraged floating rates to become more manufacturing giants. These are developed economies. 2, your domestic industries that get stronger because instead of relying on currency manipulation, industries grow through efficiency and innovation. 3, your long-term stability because floating exchange rates removes the constant political debates around when and how you need to adjust rates. But also, this looks like how states have been diversifying economic activity to go and reduce currency dependence on one sector. This is something that is made possible because of this shift. What does it look like? Note that countries whose currencies have been heavily been tied down to one sector, like Saudi Arabian tourism and Thailand, experienced extreme volatility when global price rates had fluctuated in the history. We think this incentivizes to go and diversifying this into multiple industries because economies now reduce their dependence on a single factor affecting their exchange rates. This looks like how UAE had gone and diversified from oil to tourism, finance, and technology that had reduced their dirham's vulnerability to oil price swings. Two, this is how Norway uses oil wells to go and build a sovereign wealth fund that reduces the krona's volatility. This got them three impacts. One, this ensured that currency stability was achieved even if one sector faces downturn. Two, you are able to encourage long-term economic resilience. But then three, this has attracted more stable FDI as the economy is less exposed to shocks. But then, third thing that you achieve on our end, then, you floating exchange rates weaken the Western financial hegemony and enables decentralization. How? One, you break Western monetary policy domination because when countries peg to the US dollar or to the euro, they're effectively outsourcing their monetary policy to the US Federal Reserve or the European Exchange Central Bank. This means that decisions made in Washington or the Brussels determine your inflation, borrowing costs, and economic stability in the other nations. What happens on our side is that floating rates give countries independence in settling their interest rates, managing their own economic cycles. Then, second thing, then we think that you prevent forced IMF bailouts that come with harsh conditions because one, under fixed systems, when a country runs out of their reserves, it often turns to IMF for later for emergency funding. What IMF does then is that it imposes austerity, cuts public service, and forces economic reforms that may not align with the local needs. What happens on our side is that you reduce the need for such interventions by allowing these economies to self-correct to exchange rate adjustment systems, etc., etc. But then the third thing, you encourage non-Western trade and financial cooperation because many countries have now started using local currencies for trade rather than US dollar made possible by floating exchange rates. This looks like our BRICS have been shifting away from US dependency in favor of bilateral trade agreements in local currencies. This creates an alternative financial power centers outside of the West. This does three things for you. One, sovereign economic policies, as current countries are no longer dependent on Fed or ECB to determine your state fate. Two, you are less of financial colonialism, which means developing countries are not forced to follow economic dictates of the IMF or the World Bank. But then three, you have stronger regional alliances created because countries can engage in more trade diversification without being tied to use Western financial systems. This looks like in the how you are able to encourage local trade in local currencies because one, by reducing reliance on foreign currencies, countries have now insulated themselves from external shocks and currency speculation, which means bilateral and multilateral trade agreements can be conducted in local currencies that is reducing the need for constant currency conversion existing. This looks like our BRICS are increasing their own trading in their own currencies rather than using the US dollar. Our India and Russia have been settling oil trades in rupees and rubles instead of USD. This is three things. One, reduce exposure to global currency volatility. Two, strengthens regional economic independence and monetary sovereignty. Three, this helps government business plan for long term without worrying about currency fluctuations. All of this reduce volatility. But even if you don't have to go and buy that, I think states are not stupid. They use monetary policies to stabilize the currency. This has been an incentive to go and do so. So it is post 7 because looks like one, central banks adjusting their interest rates to go and influence exchange rates. Two, when a currency depreciates too rapidly, raising interest rates can attract foreign investment and increasing demand for the currency and stabilizing its value. Three, conversely, if a country appreciates too much and harm exports, you lower interest rates that can make the currency cheaper. Oppose for all of it.
I'd like to thank the speaker for that fine speech, to ask all speakers to offer and accept points of information, and to remind speakers that 7 minutes and 15 seconds is the absolute limit. Following this, I will be cutting you off. With that being said, I'd like to welcome the member of government to begin the CG case and the back half of this debate. Here.
Cool. I hope I'm visible and audible.
Yes.
Great. If you want to ask me a POI, interrupt me. I'm not looking at chat. Time starts with my next word. OO says floating exchange rates allow developing nations to appreciate or depreciate their currencies whenever they want. 3 responses to this. Actually, 4. 1. Global South economies have massive amounts of dollar-denominated debt, which means their repayment is still based on the dollar value. So even if you can change your export prices and appreciate or depreciate your currency, the way in which you restructure and repay debt still amounts to the dollar, which means on some level you're still pegged to dollar or still affected by what the appreciation of the dollar is. Secondly, exports are still dependent on dollar value, right? So even if you want to, say, engage in swift of transaction payments to export, I don't know, cotton to the United States is still based on buying from the dollar, which means you're still dependent on how the US Fed denominates the dollar as opposed to whatever the Pakistani Reserve Bank wants to do. Thirdly, diversification requires capital inputs, which means you have to import things from developed economies, which means you necessarily have to buy in their reserve holdings, which means you're still beholden to how they appreciate their currencies as opposed to what you can do to buy them. And fourthly, the dollar remains the largest reserve currency, i.e., all SWIFT transactions are still beholden to it. So if you want to engage in any level of meaningful trade, you're still reliant on the dollar. So I think that OO makes an interesting case, but unfortunately, it's just not one that's true to the real world. And we know this is a fact because floating exchange rates have been around for a while, and we've still seen in financial crises take place every 7 or 8 years, right? So like this argument that the market will solve for inequalities in currency rates hasn't actually held true empirically. OG is focused on how floating exchange rates are volatile and a fixed exchange rate are better able to respond to portfolio crisis. They make a little bit of hand waves towards why this has spillover effects in the global south, but we're going to talk to you and mechanize for you why it is that floating exchange rates structurally disadvantage global south nations, something that OG only mentions but fails to fully mechanize. The reason you hear about the global south is because they make up the majority of the world, poverty sucks, and floating exchange rates keep and worsen that poverty. A little bit of framing. Floating exchange rates are only available to the global north. The global south still remains pegged. For example, the PKR still determined Pakistan's dollar holdings for the four structural reasons I've given you in my responses to OO. Now I want to analyze by volatility, which I think OG pretty well mechanizes for you why volatility in global north currencies translate into harms to the global south. The first reason is that the US remains the world's dominant reserve currency, which means that the Federal Reserve's monetary policy decisions have global consequences in a floating exchange system. Note that in the entirety of OO's case relies on flexibility, creating a level playing field for global trade. I'm going to prove that flexibility only exists with the developed world, and in both cases, when they're facing inflation or deflation, the developed world's responses hurt the developing world and thus structurally disadvantage them. So first scenario, when the developed world faces inflation, the Federal Reserve raises interest rates, which means global investors move money into US capital holdings to take advantage of higher returns. This causes three things. Firstly, the dollar appreciates, making US exports more expensive, which hurt the global south's ability to import things like intermediate goods that you need to diversify and create and expand industry, i.e., when the US is the one that's selling tractors to Uganda, Uganda has an exponentially harder time buying those tractors to develop wheat farms, because those tractors now cost more when the Fed raises interest rates. Secondly, capital outflows from emerging markets go into US holdings, which leads to unintended currency depreciation in those countries. For example, India, Brazil, and Turkey have all gone through massive cycles of depreciation, then appreciation when the US hikes up interest rates. Most importantly, though, it increases the borrowing costs for those countries in dollar-denominated debt, i.e., every time you take a loan from the IMF to bail you out, i.e., what Pakistan just went through last year, you have to take it in dollar-denominated debt, which means every time the US hikes up interest rates, you have to pay more on those and have to go through massive restructuring. For an example, in 2022, 3 Latin American banks had to default because their dollar debt holdings became untenable when the Fed aggressively raised interest rates to combat inflation.
POI
i.e.,
closing.
the interests of the developed world are asymmetrically different to the interests of the developing world, which means that every time they respond to inflation crises, the developed world gets fucked. Second scenario, monetary expansion in response to deflation. When the Federal Reserve cuts interest rates or tries to expand monetary supply, the dollar depreciates. This leads to two outcomes. Firstly, cheaper US exports put inflationary pressures in other economies, i.e., commodity prices rise in developing countries in response to cheaper US exports, which means capital inflows into emerging markets, which creates asset bubbles and financial instability. The example of this is pretty clear. The 2008 financial crisis led the Federal Reserve to launch massive amounts of quantitative easing, and that flooded global markets with cheap dollars. The issue here is that fueled asset price-based appreciation in those countries, which meant that places like Brazil and India went through the massive kinds of speculative attacks that spill over into those nations. Again, OG fails to mechanize why speculation spills over into the global south. This is the reason you need to prove that case for you. Now let's talk about depreciation and financial institutions. Before that, I'll take a POI from OO. Actually, no, CO. Let's hear your case.
Okay, so my question is, how does this have any relation with the domestic market? Considering that exchange rates are only relevant really on foreign exchange and like international trade.
All of this matters because floating exchange rates give the U.S. Fed untenable power to increase monetary policy, or either in terms of quantitative easing or decreasing. The issue here is that when the Fed has floating exchange rates and doesn't have discipline in those things, it creates spillover effects for the developed world, for the developing world, right? So a floating exchange rate that gives the Fed the ability to do as much as it wants to change money supply spills over into the developing world's ability to access things like stable commodity prices or speculative attacks. That spillover effect, I think, is what's really bad here because it creates massive amounts of problems to the developing world. Now I want to talk about financial institutions. I think the issue here is that because developed economies have the ability to appreciate or depreciate the currencies as it suits them, what you create is a level of arbitrage or trading of currencies, i.e. when China or Australia decide to devalue, all of the other developed economies race to the bottom to remain competitive, i.e. when China tanks the renminbi to sort of make their exports more competitive, all the other economies have to adjust to sort of remain competitive in that world, which means these spill over into global shocks which impact developing economies the most. This is to say that you create a level of asymmetry in how many loans each side can take. So for instance, in the IMF, SDRs are generally are given based on a quota system and oftentimes privilege developed countries over developing ones. Because the US is able to take loans denominated in dollar value, it means that the US can take as many loans as it wants. That's why it has trillions of dollars in debt, because they can restructure payment cycles and repay that dollar debt and devalue that dollar debt whenever they want, which gives them the competitive advantage of being able to outpay or outbid the developing world. On the flip side, the developing world can't do that because they lack the same level of dollar reserves to be able to remain competitive in the same way. Which means when the U.S. economy is strong, every time a developing nation tries to take out an IMF dollar-denominated loan, their ability to repay that loan is structurally dependent on whether or not the U.S. Fed hikes up or decreases interest rates. On all those grounds, we've given you three structural reasons for why the developing world is structurally disadvantaged when you have a floating exchange rate. On all those grounds, proud to propose.
I'd like to thank the speaker for that fine speech and welcome the member of opposition to begin the case for CEO. Hear, hear.
Hello, hello, audible, visible?
Yes.
POI is in the chat, everyone. All right, closing oppositions either misread the motion or their internet connection hasn't allowed them to listen to the match accurately because they're misrebutting a lot over here, right? Number one, I don't think the motion tells you or gives you the fiat to assume that developing countries have made any transition into anything, right? The motion just tells you that developed countries have made a transition from making their currencies go from fixed exchange rates to floating exchange rates. The developing world, given Sarim's 4 reasons, was dependent on the USD and other developed countries and continues to do so. The motion gives you no fiat to assume that developing countries have changed. I don't think you can run with that, right? Sarim explained to you that even if the developed world runs on like floating currencies, the vast majority of commodities in the world and the vast majority of developing countries in the world have tied their currencies to developed countries. What do I mean over here? The USD or the Australian dollar are sure completely floating, but the oil price, for example, is pegged to the US dollars market, or the PKR or Egyptian currency's value is pegged to the US dollar market via fixed exchange rates. The motion gives you no fiat to assume that these developing countries or these commodities have moved over to floating exchange rates. I don't get CEO's rebuttals here. I think they're misrebutting massively. But now what is Op Bench's big argument here? And both teams run essentially the same presumption. Their big argument is that speculation and forces of supply and demand allow you to accurately value currencies. Notice this is the only premise they have. They say once you accurately sort of give value to currencies, all of our many benefits happen. There's multiple problems with this. Number one, they've given you no reasons to believe why the forces of supply and demand give you accurate forces, right? Because we tell you the following. Number one, the vast majority of people over here are speculative investors, i.e. these are the kinds of people who wait for signals to happen in the market and then create things like bubbles or create things like cash pullouts, because no one in this market wants to lose money. This is unlike markets for like commodities or goods, because paper in and of itself has no value. The only value it has is speculative relative value. You can't price this, you can't run the same analysis you would for like a bucket of mangoes when it comes to supply and demand, because the supply and demand here is affected or by what people think the value of this piece of paper is. This is why speculation very often doesn't give you accurate values. Speculation is very often the market reacting to any change that has happened in the currency. So for example, if the US elections emerge and a new president comes about, because people are very worried about the instability that will happen, everyone suddenly starts selling the US dollar. Seeing that people are selling the US dollar gives a signal to the rest of the market as well that we need to sell also. Often markets behave on principles like these. Number two, their big allegation that governments cannot intervene with the floating system is a straight up lie. Because what do they tell you? They say that no, but it's like a lot of supply and demand forces. My brother, the biggest supplier of currencies in any market of currencies is the host country. So the US dollar has the asymmetric ability to supply dollars the way they want to, when and how much they want to. This is why governments have the unique ability to mess with the supply demand forces of this market and not just leave it up to the ether like you say it would be. But number three, they lie when they say that governments just, you can't mess with it, like you're just not allowed to mess with it. That's the point of floating currencies, that you can devalue them whenever they want to, because their value isn't pegged to a fixed commodity like gold, etc. What happens when you have fixed exchanges? You say all of the currency I will print is equal to this bottle's weight in gold that I hold. If I print more cash, the total value still remains this weight of gold, right? When you peg it to a fixed commodity, you no longer have the ability to say I am devaluing it or changing this value based on my moods and vibes, right? The only thing you need is for people to buy into the value you determine for that thing, rather than have to keep a fixed commodity to peg it to. The difference over here is that buy-in obviously exists for developed countries. Why does buy-in exist for developed countries? Why will people keep demanding the US dollar even when the US keeps messing with the US dollar's value? Number one, as Sarim explained, the vast majority of import commodities are happening, no, I said in the chat, are happening in the developed world's currency, i.e. everyone constantly needs to keep dollar with themselves to buy things in imports. Three other reasons Sarin gave you, by the way, for this, why developed countries just need to keep dollars. This means that the developed world can continue printing as much as they want to, and no inflation doesn't happen because there is an external demand of the cash they continue bringing. This is why the closing opposition rebuttal, but international exchange rates are the only things that get affected, is irrelevant, because sure, international exchange rates get affected, but via the international exchange rates, the dollar you buy is what allows you to do all other economic activity. So even if you're buying oil, the fact that oil is denominated in the US dollar means that if the US dollar's value fluctuates, oil's value also fluctuates. This is why, for example, domestic changes impact so much in global trade deficits. The last thing that opposition bench as a whole pushes to you is because the government can't intervene over here. Again, I've proven this is an assertion. What happens is that the market is always able to do some level of correction on itself. There's a couple of problems with this. Number one, this assumes that the market often seeks to correct to the precise value as opposed to benefit themselves. What do I mean over here? Developed economies have the ability to export inflation whenever they want to. What do I mean by this? It means that even when I devalue my own currency, because I devalue my own currency to do things like make it more export heavy, make it more export friendly, its demand always is cyclical, i.e. I devalued my dollar so that a lot of people want more exports that are done in dollars. That suddenly raises the demand of goods sold in dollars. It doesn't even need the dollars demand to increase. Just because goods sold in dollars have higher demand now means people will need to buy dollars to purchase those goods, which is why these currencies are often able to export inflation. You can print as much as you want to, and the reason why you don't have to bear inflation is because many of the things that get inflated, like oil, like any other thing these developed economies export, is going to be exported to the rest of the world. The rest of the world's demand for their inflated good means that developed economies can just export their inflation outside. In a fixed exchange rate, their ability to print that extra money doesn't exist in the first place because they can't devalue value because there is a fixed amount of good to which they have pegged their economies. This is something that the entire opposition bench just keeps on ignoring. In the absence of them shooting this down, all of Sarim's impacts about loan asymmetry, about developed countries being able to pull wealth inside them whenever they want to, and lastly about this being structurally unfair for developing world continue to hold. So proud to propose.